Those three statements are: number one is the profit and loss statement, number two is balance sheet, and number three is the cash flow statement. Let us make the beginning with profit and loss statement. And what I'm going to do, friends, I'm going to explain this profit and the profitability with an illustration, with numerical illustration, so that it becomes very easy for you to comprehend. Not only it becomes very easy for you to comprehend, but it also sticks in your memory so that you are able to use it in your business and in your profession. So why do we prepare the profit and loss statement, and how to figure out whether a profit and loss statement is a good one or the bad one? Let me quickly tell you about this. See, profit and loss statement tells you what is your income and what are your expenses. And the difference between the two is either profit or less loss, depending on whether income is more or expenses are more. So that is what the P&L will tell you. And this profit and loss statement is used for the purpose of decision making, for the purpose of risk management, for the purpose of value creation, for the purpose of performance evaluation. And we will, as we go, we will also keep on understanding as to what purpose and how, what purposes the P&L serves and how. So let us begin. See, first thing that you see here is your sales. So let's say this company has a sales of 1000 crore, right? Okay. So remember, this sales is also known as turnover. It is also known as total revenue from operations, and it is also known as top line. And I'm sure you can understand why it is known as, why it is also referred as top line. It is also referred as top line because in this statement that you're seeing on your screen, this is the line which is on the top, and that is why sales is also referred as top line. Now what we do from the sales,
we can't see the screen. We are still on understanding basic financial statement.
All right, thank you so much. Thank you so much. I will just do one thing. I'll just stop share and again start the share and share the screen so that this problem does not happen again. And are you able to see it now? Are you able to see my screen, Excel sheet?
Yes, sir. Yes.
Oh, fantastic. Thank you so much for that that reminder. I think it's very useful. So whenever you come across any such difficulty, please do let me know, and we would take care of that actually. Okay. So just to start from the beginning. So this is your P&L. This is your P&L that you see on your screen. In the P&L, the first thing that we have is our sales. So sales is also known as turnover. It is also known as revenue from the operations, or it is also known as top line. And why it is known as top line, as I was explaining to you, this is known as top line because this is the line which is appearing in the P&L statement on the top, and that is what is known as top line. So meaning what? Meaning when someone is saying how is the top line of your company, so basically what he or she is asking you as to how is the sales of your company. So that is the first thing that we need to understand for understanding the profit and loss statement. Now what we do from the sales, we deduct the first cost that we incur in our business. And what is the first cost that we incur in our business? Remember, it is the raw material cost. It is the raw material cost. So let us say this company has a raw material cost of 400 rupees, 400 crores or 400 rupees, doesn't really matter. Ultimately, our objective is to understand the concept. Crores or millions or billions or trillions is not so significant. The next thing that you do in your profitability to understand the profitability is to deduct the manufacturing expenses. Remember, that is the next cost that we incur in any business, and that is manufacturing expenses. So you call it manufacturing expense or you call it manufacturing cost, it doesn't really matter, both mean the same thing. So let's say this company has the manufacturing cost of 100 rupees, right? So what we do from the sales, from the figure of the sales that you have, you deduct the material cost and you also deduct your manufacturing expenses. What you get in your hand is your gross profit. It is your gross profit. Now, some people call this gross profit as gross margin. Some people call it as gross profit margin. Some people call it as gross contribution. Some people call it as gross value addition. Remember, they all mean the same thing. They all mean the same thing. Also, please remember the raw material cost and the manufacturing expenses put together. They are known as COGS. So I'm sure you hear this term called COGS, cost of goods sold. So what is cost of goods sold? Cost of goods sold is nothing but total of the raw material cost and the manufacturing expenses put together. Now remember, and I'm sure this question must be coming in the minds of many of you. What if I'm not a manufacturing company? What if I'm only a trading company? So now the basic format of the profitability will remain the same. The only difference is if you are a trading company, then you will have a raw material cost. That means you will purchase the material and that is what you're going to sell it further. But since you're not doing any manufacturing process, therefore in that case you will not have the manufacturing expenses. That is the only change that will happen in case if you are a trading company. In case if you're a trading company. It is also possible that you are not a manufacturing company, you are not a trading company also, you are an IT company. So if you are an IT company, then how will the P&L be prepared? Again, very simple. So what is going to happen is, in case you are a IT company, you will not have the raw material cost, you will not have the manufacturing cost either. So, but what you will have as an IT company, you may be a product company or you may be a service company. So if you are a product company, that means you are developing products, IT products. So the cost that you will be incurring on the employees of your company, which are directly engaged in developing of those products or providing those services. Now that cost will come here, not as the raw material cost or the manufacturing expenses. That cost will come here as cost of product development or cost of service provision. That is what it will come. So ultimately, you will not have the material cost, you will not have the manufacturing cost. What you will have the cost of product development or cost of service provision, and that is all. And so again, you will arrive at the figure of gross profit. The point that I am trying to drive home is, it doesn't really matter whether you are a manufacturing company or you are an IT company or you are a trading company or you are a service company, you will have a figure of gross profit. And please remember, this gross profit is very important for every one of us. So more so for all of you as the business owners, promoters, directors, this number is very, very important. And why this number is very important? Because higher this figure, stronger is going to be your company. So higher this figure of gross profit, stronger is going to be your company. And therefore, for the purpose of control, for the purpose of management of the operations of your business, you need to constantly monitor one of the number, and that number is your gross profit. Now what we do, from the gross profit, we deduct a cost which is known as SG&A, selling, general and administrative expenses. Please remember, in the finance, it is very simple. There is no confusion. What is a manufacturing cost? What is a manufacturing expense? Very simple. An expense which is being incurred on the manufacturing is a manufacturing expense, and that will come here. That will come here. An expense which is being incurred on the administration, that will be part of your SG&A, selling, general and administrative expenses. Selling, general and administrative expenses. What will be part of the SG&A? So whatever expenses that you incur on selling your product, distribution of your product, administration of your company, and that will include all the expenses that you would incur on administration, and that is your SG&A. Let us say, for example, now this company has an SG&A of 100. Now what you have from the gross profit, you minus the SG&A, and so from the gross profit Right. So from the gross profit, that is 500, you minus the SG&A, that is 100. So what you have in your hand is 400, and that is what is your EBITDA. That is what is your EBITDA. So all of you, and I keep repeating it time and again, you need to understand this number very, very clearly for your business. And when you go and join board of a company as an independent director, even in that role also, EBITDA is a very critical number, very, very important number for any business. And why is that so? That is because EBITDA is an indicator of three things. Number one, it is the most important number. It is the most important number, and let me tell you how important EBITDA is. I was working with a company called ArcelorMittal, and Mr. Lakshminivas Mittal, who is the CEO and the chairman of the company. I was with the company for 6 years. In those 6 years, Mr. Mittal and otherwise, Mr. Mittal would send a communication, a mail to all the top executives of the group after the quarterly release. I received 24 such mails from Mr. Mittal during 6 years that I was with them. You can imagine the importance of EBITDA from this fact that the CEO, chairman of a group like ArcelorMittal, which is world's largest steel and mining company. Now in his mail, there would be 3 messages every time. And those 3 messages, number 1 was with regard to the health and safety. So health and safety was so important in our group. Number 2 that he would highlight always is the EBITDA. And number 3 he would highlight is the deleveraging, that is reducing the debt. So you can imagine how significant is the EBITDA. And let me tell you why EBITDA is really so significant. If we were to, in a face-to-face situation, live situation, offline situation, then of course I would have asked all of you these questions. But now that we are in a virtual mode, let me explain to you why EBITDA is so important. Remember, what makes a business run? A business is not run on the strength of anything else. It runs on the strength of the cash. So what gives a life to a business? The life to a business comes from the cash. And please understand, cash in any business can come from 3 sources. What these 3 sources are? These 3 sources are, number 1, the cash can come from the equity that you put from your pocket. Number 2, the cash can come into the business from the debt that you take from the banks and the lenders and the financial institution. And the third cash that can come from a business is from your EBITDA. So, आपके business को, to your business, the long life will come not from the equity, cash coming from equity, not from the cash coming by way of debt. Why? Because equity has a limitation. As a promoter, as an owner, how long can you put money into any business, into your business? There's a limit up to which you can put money from your pocket. As regards the debt also has a limitation. And what is the limitation? Limitation is how anyone who will lend you money will always look at your EBITDA first. Only if your EBITDA is good, then only he would give you money. But the EBITDA is something which is the most important because this is free of any kind of an obligation. Equity, you have to pay dividend. Debt, you have to pay interest. On EBITDA, you do not have to pay. You do not have to pay any interest. You do not have to pay any dividend. Plus, EBITDA, you do not have to return also. You do not have to return. So the business does not have to return EBITDA to the shareholders or to anyone else for that matter. And that is the reason why EBITDA is so important. I'm sure this question must be coming in the minds of every one of you. What are the things that I must keep in mind for controlling my business? So one of the number that you need to always worry about, you need to always focus is your EBITDA. And please remember, as the owner of your business, you do not have to compute EBITDA. You only need to ensure that people who are working in your accounts department or finance department, they submit this number to you every day, and this is possible to calculate this number every day with the current IT infrastructure that we have. So that's number one. Number two, please remember, EBITDA has got direct relationship with your borrowing. तो आपकी जो borrowing है और उसका और EBITDA का direct connection है. What is the connection between the EBITDA and your borrowing capacity? So remember, anyone who will lend you money, let's say for example, you want to go for expansion, or you want to go for, or you want to go for diversification. So anybody will give you loan only when he will check whether you have the capability of repaying the debt, whether you have the capability of servicing the debt. How will you service the debt? How will you service the debt? How will you repay the loan? Remember, you can repay the loan only when you have a good EBITDA, a good EBITDA. And by the way, EBITDA is also known as cash operating profit. Cash operating profit. Why EBITDA is known as cash operating profit? No rocket science. EBITDA is known as the cash operating profit because this is the amount of cash that you are getting in your hands from your operations. So that is why EBITDA is also referred as cash operating cash profit, operating cash profit, or cash operating profit. So both mean the same thing, and that is what we need to remember. Now from the EBITDA, what we do, from the EBITDA we deduct a cost which is known as depreciation. Let's say this company has a depreciation of 50 and it has a amortization of 25. What is a depreciation? What is an amortization? I'm sure this question must be coming in the minds of every one of you. So I would like, in case someone would like to explain as to what do you understand by depreciation and what do you understand by amortization. Anyone?
So amortization is more of
Yes.
amortization is more of the brand value or the brand name, the intangible assets that the company collects.
Mm-hmm.
And depreciation is, like let's say if you have machinery, the wear and tear and all, the
Very
value
good.
gets appreciated, right?
Very good, very good, very good. So remember, in our business, we use two kinds of assets. We use two kinds of assets. Number one, we use something which is known as tangible asset. So what is a tangible asset? Tangible asset is something that we can touch, we can feel, we can see. That is tangible asset. So plant and machinery, furniture, computer, office equipment, aeroplane, train, yacht, these are all examples of tangible assets. And the second category of the assets that we use in our business, those are your intangible assets. So what are the intangible assets? Intangible assets are the ones that we cannot touch, we cannot feel, and we cannot see. Now, goodwill, software, patent, design, trademark, copyright, logo, brand name. Now, these are all examples of some of the intangible assets. Please remember, it doesn't really matter whether you are using a tangible assets or you are using an intangible asset. The fact that you are using these two assets, their value is going down year after year because of the wear and tear. So the point is, what is depreciation? So reduction in the value of a tangible asset is known as depreciation, and reduction in the value of an intangible asset is known as amortization. In simple words, if I can put it, I would say what depreciation is for tangible assets, amortization is for intangible asset, and that is how we can understand as to what is depreciation and what is amortization. Now from the EBITDA, what you do, from the EBITDA you minus, from the EBITDA we minus the depreciation, and we also minus the amortization, and what we get in our hand, we get in our hand something which is known as EBIT. So we minus the depreciation and we also minus the amortization. What we get in our hand is known as EBIT. EBIT, remember, is also known as operating profit. So sometimes people say EBIT, sometimes people say operating profit. Remember, both of them mean the same thing. Now what you do from the EBIT, you deduct your finance cost. So you call it finance cost, you call it interest, you call it borrowing, cost of borrowing. They all mean the same thing. They all mean the same thing. Some people say interest, some people say finance cost, some people say cost of borrowing. They all mean the same thing. So now let's say this company has got a finance cost which is of 25. So what we do, we deduct from the EBIT, that is earning before interest and taxes, we minus the finance cost or the interest or the borrowing cost. What we get in our hand is known as earning before tax and extraordinary items. Earning before tax and extraordinary items. Right. So I'm sure this question must be coming in the minds of every one of you. What is the meaning of extraordinary items? So the definition is very simple. So what is an extraordinary item? An item which is not an ordinary item is an extraordinary item. It is really as simple as that. Meaning what? Meaning in your business, and I'm sure all of you must have done it many times. In your business, let's say you are a manufacturing company. So what you are doing? You are producing goods and you are selling them in the market. So you are getting sales, and that is your operating income. That is your ordinary income, right? That's an ordinary item because it is happening in the ordinary course of business. Sometimes it can happen that suddenly you realize that you have a piece of land lying somewhere, and you also realize that this piece of land you are not going to use for any times to come, and therefore you take a decision to dispose of that piece of land. And now this land that you bought, let's say 10 years back, you bought it for 1 crore, and today the value of this land is 10 crore. So what is going to happen, when you sell this land, it is going to give you a gain of 9 crore. 10 crore is the sales minus 1 crore the cost at which you bought it. So the difference 9 crore is your gain. Now tell me, is this gain of 9 crore that you are getting from the sale of this asset of your company, is it your ordinary income or it is an extraordinary income? Apparently it is your extraordinary income. So extraordinary income will also mean it is not an operating income. This is not the income that you are generating from the operations of your business. This is coming something out of the operation, and that is how it is known as extraordinary items. So please remember, it's not that you can only have extraordinary profit, but you can also have at times items of extraordinary expenses. So what does it mean? It means, let's say for example, someone is owning a factory, someone is owning a godown. Unfortunately, one day that godown caught fire, and the godown caught fire, so the goods that were lying there were destroyed completely. Fortunately, the company had taken the insurance. But the insurance that the company had taken was for 10 crore, and the damage of the goods that happened was 11 crore. So now what is going to happen? Since the godown was insured, the insurance company will give you reimbursement of 10 crore. But this 1 crore by a loss that you have, they are not going to compensate you because your insurance policy was only for 10 crore. So this 1 crore loss that you are going to incur in your business is your, again, an extraordinary item. And that means what? That means this is not your operating expense. This is an expense which is completely out of your operations. And therefore, this has to be shown separately. As a loss of asset due to fire. I am sure all of you would be able to realize as to why these items of profit on sale of land or loss on account of fire, why do these items in the P&L need to be shown separately and not merged together with the operating expenses and the operating income. The reason behind is very simple. If you merge them together, then anyone who is reading your profit and loss statement will come to a wrong conclusion. Why wrong conclusion? Because you have included a profit of 9 crore as part of your operating income. And therefore, he would think that your company is extremely profitable. And thereby, he would take a decision about your company. But that income of 9 crore on account of sale of the land is not going to happen every year. So that means your numbers, if you merge them together, will be misleading. And that is why the accounting standards that we have in this country and globally make it mandatory that non-operating income and expenses or non or extraordinary or exceptional items of income and expenses got to be shown separately, and that is how this will happen. So let's say this company has earned a profit on sale, just to keep it simple, 30 crore, and this company has incurred a loss on account of sale, let's say of 2 crore. So now what we do, from the figure of EBT and EI, earning before interest, and the extraordinary items, we minus we first add the profit from the sale of the land and minus the loss on account of fire, and then we arrive at the figure. Now this is your earning before tax. This is your earning before tax, EBT, and you can understand that means this is the amount of profit on which you have to pay tax. Since all of you are business owner, all of you are directors on different boards, you're the shareholders, you're the promoters, I would also like to clarify here for your benefit. This EBT is earning before tax, but remember, you do not pay tax on the figure of EBT. EBT becomes basis for arriving at your taxable profit. So there is something which is known as EBT, earning before tax, and then there is something which is known as taxable profit. Taxable profit.
Me, that number 15 should be 328, right? You are taking minus 2 from 330.
Once, okay, thank you for that correction. So this is the profit that we have. This is the figure of EBT and EI that we have, and this is the profit which is getting. This is the profit that has come to the company. So now you're right. So what I made a mistake. So this is how it should be. Okay, because I minused it, so minus became plus, and that is why that number was coming wrong. So thank you so much for that correction actually. Okay, so remember, now you don't pay tax on EBT. Not that all of you will need to calculate your tax liability, but for sure all of you need to know how the tax liability of your business is getting computed by your chartered accountant or by your financial advisor or whoever that gentleman may be, or your finance manager. Why is that so? Because as the owner of the business, all said and remember, you got to be in the control and not the external agencies or other people. So you must know how the tax liability is calculated. So firstly, the EBT, the earning before tax, becomes the basis for the purpose of computation of your taxable profit, but you will not pay the tax on the amount of EBT. You will pay tax on the amount of taxable profit. Now what does it mean? It means under the Income Tax Act, this depreciation that you have is different. And why the depreciation under the income tax is different? That is because the government wants more industrialization to happen. The government wants you to add more assets. So if you have to add more assets, the government gives you an incentive. There are many incentives which are given, which I am sure most of you would be aware. So they will give you incentive, go to different zones, and when you go start SEZ, or you start GCC, or go to IFSCA, International Financial Center, which is in Gujarat. I'm sure many of you must have heard of it actually. So the government gives you many incentives, and incentive for doing more industrialization, for adding more assets. So you will make adjustment for all those incentives and all those provisions in the figure of EBT. And when you make all those adjustment in the figure of EBT, then you arrive at the figure of taxable profit. And then on this taxable profit, depending upon whether what you have opted for, so whether you are eligible for 22% or 25% or 30% rate of tax, that tax will be applicable. So as per the Income Tax Act, if you are a company having a turnover more than 400 crore, the tax rate that you applicable to you is 30%. If you are a company having a turnover of less than 40 crore, 400 crore, you have these options. So either you can opt for 22% or you can opt for 25%. So 22% in case if you want to opt for, in that case you will be foregoing all the incentives that the government would offer. If you want to opt for 25% rate of tax, in that case you can take the advantage of all the incentive schemes which are offered by the government for the purpose of encouraging you to make more industrialization, add more assets. And that is the call that you will take. But now that you know that this is also available, so instead of depending someone and telling him aap dekh lo, you decide kitna karna hai, no, you have to take every decision in your business have to be taken very consciously. So you must know, and now that you have an idea as to this is the provision, I'm sure you would be able to demand this from your team, and that is what should happen. So let's say this figure is 328, and now what you will do, you will deduct the tax from this. You will compute the taxable profit on the taxable profit. On the taxable profit, you will find out how much the tax. Let's say that amount is coming to 100. So you will take that figure of tax 100 here, and now what you will do, so from the EBT you minus the figure of corporate tax, and what you get in your hand is your EAT, earning after tax. So this is your EAT, earning after tax. Now some people call it EAT, some people call it as PAT, some people call it as net income, some people call it as net profit, some people call it as bottom line. And I'm sure you can understand why people call it as bottom line. People call it as bottom line because this is the figure which is appearing in the bottom of the P&L. So that is why they also call it as bottom line. Now with this understanding, I would like now to take a pause and leave it open to every one of you to ask your questions or your doubt in this regard, and then we will do the remaining part of the profit and loss statement. So over to Usha ji, over to you.